Okay, here I'm going to run through a couple reasons why I do not trade foreign exchange. I've gotten this question from a lot of students, so I figure I'll address it. A couple of these are going to be particular to the foreign exchange market, and then a couple of them are just related to predicting currency movements. So starting with the easy stuff, I wouldn't trade in foreign exchange markets. Now, a foreign exchange market is just interbanks, right? So there is no centralized market. So I have first here, there's no best bid and offer. So in U.S. exchanges, we have a lot of different exchanges. The feed, all these different, the order books come into one feed, the consolidated tape, so you can look at the best bid and offer, best bid and ask for any given stock at any given time. There's nothing like that in foreign exchange markets. It's just an interconnection of banks. There's a foreign exchange, the U.S. trades, and then Japan trades, and then the European markets open, and so depending on what time it is, there's different banks that are trading it, and then who you are dictates the access to the market. So if you're a larger trader, you'll have better bids and offers than you would get if you're a smaller trader. So there's no central market. You can get, definitely if you're a small trader, bad quotes. A couple other considerations is trading foreign exchange. You should look into whether that's going to affect your SIPC protection. Again, that's only if your broker fails, but the idea of losing SIPC protection, I don't particularly like. The counterparty risk, again, this is a very small risk, but there have been instances where people trading in the United States have been trading foreign exchange with a foreign bank. The counterparty is a foreign bank, and they haven't been paid. The problem there is you, as a small investor, if you wanted to get your money, would have to go sue that foreign bank in the foreign court. There's no regulator. There's no SEC that might take your side on this. The U.S. regulators don't care. So there's a lot of reasons particular to the foreign exchange market. Now, I've noted here that, okay, well, if you want to get around that, you could trade US-based ETFs that track the euro or the yen and so forth. So you can get around this sort of stuff, but I still don't trade those things. I don't trade, foreign currency ETFs or foreign currency futures. So now, these two are just particular to predicting currency movements. One of the things to consider is if you're trading the Swiss franc, the Swiss central bank has been very forceful in intervening to push down the value of the franc. So the idea here is that, you might be speculating that the franc goes up, but you're trading against the central bank, and the central bank can print as much currency as they want, and then they don't necessarily have to tell you when they're going in and intervening. So it's not like you could take this long position in the Swiss franc and then have the Swiss central bank come out and just start, unbeknownst to you, pushing down the value of the franc. So the idea of trading against a central bank, it's kind of analogous to the whole idea of don't fight the Fed, right? So I guess what that means is you could trade alongside central banks, but sometimes you don't know what they're doing or when they're going to intervene and so forth. So you have these big players in the market that you might trade against you. One thing I haven't listed here is, if you want to trade, currencies now, large macroeconomic models can be useful. I don't really want to build one just for currency trading. The last one is what I really want to talk about, though, however, because in talking to a lot of students, they'll bring up, well, George Soros made a bunch of money, and they might have heard the story of George Soros, or just kind of heard the headline, breaking the Bank of England, right? So made a bunch of money trading currencies. So what I want to end here with the major explanation of why I don't trade foreign exchanges, the way that happened, that trade is not possible today. So let me go a little bit into the Soros trade, how he made a bunch of money, and why you can't do that today. So breaking the Bank of England, what this refers to is the British pound used to be fixed to the Deutschmark. Now, what this means is if the currencies are fixed, let's just say 1 for 1, right? So the currencies are fixed 1 for 1, then this ties interest rates together. So the idea here is if Germany has 10% interest rates, then England has 10% interest rates. England can't have 7% interest rates, and Germany have 10% interest rates with a fixed foreign exchange, because what will happen is everyone will borrow money in England, I'll borrow money in England, I'll have to pay 7%. I convert that over to Deutschmarks, I invest it, earn 10%, right? And I have no currency risk here because they're holding it fixed. So I net 3% in arbitrage. Now, this is not I make 3% on my own money. This is this is an arbitrage. I'm getting 3% not off my own money. I'm borrowing money over here, investing it over here. It's none of my own capital is involved. This is an arbitrage. It's just a money machine. So how much do you do this for? Well, however much I can borrow here and invest here, $1 million, $1 billion, as much as I possibly can. So, and this is going to be underlying what happened in George Soros's trade. So what happened? England and Germany had fixed exchange rates before the euro. So it was British pound, Deutschmark. Germany's economy was doing better. So Germany started raising interest rates. Now, again, to keep this fixed, England would have to start raising interest rates as well. However, there was a lot of, and this it goes to central bank independence, but there was a lot of pressure by English politicians not to raise interest rates, because if England is not growing fast, their economy isn't growing fast, and they start raising interest rates, that's going to really, it's going to slow down the economy, it's going to increase unemployment, a politician's worst nightmare. So what Soros and people working with him, I think Rogers and so forth, realized, okay, well, Germany is raising interest rates. England doesn't have the will to do it. So what they're betting on politicians here, basically. Again, not on foreign currency movements. They're betting on politicians. They're saying these politicians and the central bank they won't do what is necessary to maintain the peg. Right? They won't raise interest rates. So what, again, Soros and a lot of other funds do is they start borrowing a lot, just like we said. They start borrowing a lot in England and converting it into Deutschmarks. Now, what this means is that if I borrow in British pounds and I'm going to convert that, I want pounds to Deutschmarks, I'm going to sell pounds and I'm going to buy Deutschmarks. Now, to maintain the peg, the British central bank, the Bank of England, has to be on the other side of that. So I'm buying Deutschmarks and selling pounds. They have to sell Deutschmarks to me and buy pounds. Remember, a central bank doesn't hold a fixed currency, a pegged currency, by just saying it has to be this way. The central banks actually sit there and defend the peg through buying and selling. So if I'm a hedge fund and I'm converting the British pounds to Deutschmarks, well then the Bank of England has to be buying those pounds and then selling those Deutschmarks. So Soros hedge funds, they're doing that, right? And so the Bank of England is defending it, right? But they have a reserve of Deutschmarks, and they can only defend it so long as they have Deutschmarks to sell. So they actually start running out of Deutschmarks, and they were lent more Deutschmarks from the Bundesbank, the German central bank, and then they start running through that, and eventually they just couldn't maintain the peg anymore, the fixed exchange rate. And so the Bank of England says, okay, well, we're not going to defend it anymore. And then what happens is immediately the Deutschmark goes way up and the British pound goes way down, right? So that's called, the breaking the Bank of England, and how Soros and a lot of funds made a lot of money very quickly, right? Of course, this is at the expense of the British central bank. Now, they were, in essence, short a lot of Deutschmarks, which just went up, and they bought a lot of pounds, which just went down. So this is, a very large loss from the Bank of England. This is, largely why I think a lot of the English don't want to join the euro. They've had fixed exchange rates before, and it didn't work out. But at its core, this was the trade on politicians, right? This is not a foreign currency. So now you're sitting there. So if you're using this as kind of like, oh, people made a lot of money trading foreign currencies in the past. Well, now, right, the U.S. versus the euro, this is a floating exchange rate, right? So it's much harder to predict. It's much easier to predict that a politician won't raise. Again, I'm blurring the lines between central bank and politicians, but again, there's interplay there, just like there's interplay between our politicians and our central bank. But it's much easier to bet what they're going to do, particularly not raise interest rates, than it is to sit there and say, okay, well, I'm going to look at trade flows. If you were to trade foreign currency today, you got to looking at trade flows and interest rate differentials, and you've got to sort of predict all this stuff, and maybe I can predict what the euro is going to do. So, largely, long story short, a lot of the ways people made a lot of money trading foreign exchange was only possible in the past. These exchange rate regimes do not exist today. Today, there's a bunch of managed floats, basically, where currency floats freely and it is pushed around by central banks. So it is not a conducive market to make a lot of money. I would have, at least for me, and again, you do what you think is best, but I find it's much better to buy Tesla and Nvidia in tech stocks, right? Even now, than try to predict, what's going to happen with the yen. Now, if they start fixing exchange rates and you start to get this, then that's a whole different story. But in a freely floating, managed float regime, it's very hard to predict these, and it's, at least for me, not worth the time. Have a great day.